Hello, this is Steve Sanangelo from the SRS Rock Report with the new YouTube update. The global economic breakdown will force investors into silver, and why one key silver investor will drive the price in the future. Now, this is an important update because I'm going to tie in several different factors. The World Silver Survey just put out its new 2022 Silver Survey. I'm going to show a little bit of that new information, but I want to tie it into what's happening because we're starting to see what I call the breakdown of the global economy, the global supply chain, and that's all due to what I call the energy problems, the coming energy cliff. And this is the reason why it's very important to be in the precious metals. Now, before I get into the silver charts, I want to talk about energy because I've been looking at and analyzing the precious metals for 15 years now. But I recently started talking about energy because I realized that the cost to produce gold and silver, the main ingredient, the main factor is energy. And so now I realize that it's energy it basically drives the global economy. If you don't have energy, you don't have an economy. So to understand what's happening with the economy, with asset prices, with the financial system, with the precious metals, with all stocks and bonds and real estate, you have to understand energy. If you don't understand energy, which most economists don't understand energy, then the analysis is faulty. Now, financial markets steer the economy, and oil production growth allows for economic growth. And so that's a very important chart. Now, I've been talking about the coming energy cliff. This is what it looks like. I spend more time at the SRS Rock Report detailing this in more detail to the subscribers. But basically, debt has allowed us to bring forward production at a higher level. And unfortunately, the downside is going to be very cliff-like, and the market is not prepared for that. Now, I believe that's going to happen circa 2025, plus or minus a few years, and it looks like it's going to be more minus. And now it's important to understand that the global oil production versus the U.S. and Canada, if it wasn't for the United States and Canada, mostly the U.S., we wouldn't really have had any oil production growth in the world since the 2008-2009 financial crisis. The rest of the world is shown in the olive color. The U.S. is in blue, and Canada here is in red. So from the period of 97 to 2008, if we look at the rest of the world, which is minus US and Canada, 12.7 million barrels a day of oil production growth came from the rest of the world. Matter of fact, the US and Canada was minus 0.7 million barrels a day. Since the 2008 financial crisis, it flipped. Well, that was as of 2019. It's actually worse for the rest of the world. US and Canada was up 12.6 million barrels a day. The rest of the world fell 6.3. And a lot of that was OPEC, Russia. So the thing is, all the growth came from the United States. Now, that's bad news because I've been warning my subscribers that most of that has come from the US shale industry. And unfortunately, the US shale industry has a 48% decline rate every year. So you have to replace that every year. So this massive growth that the world has enjoyed, which has allowed economic growth, has come mostly from the US, we're losing almost half of that every year. And now we're starting to understand that it's becoming impossible for the shale industry to continue growing like it did in the past. So this is the US oil production, and this is what the EIA estimates. We're going to see 13.3 million barrels a day by the end of 2023. But even if we get there, which we may not, I don't think we're going to get there. It's not much more than it was back in November 2019, and that's 4 years. Look how much growth we had from 2016 to 2019. Tremendous growth. We had almost 4.5 million barrels a day. We almost can't get back to breaking even in 4 years. And so this is an issue. We're not going to have the growth in the world due to the United States shale industry. And I'm writing also, I talked about this to the subscribers. Global oil production is declining faster than the industry realizes. The decline rate in the world is much higher than we realize. So now that's why the world is reaching the energy cliff even before the Russian-Ukraine war. That just put a spotlight on the problems and has made it worse. And then we've got the gas, right? Because Europe is in serious trouble because they import the most natural gas in the world. Asia comes second. These two regions are going to be negatively impacted by falling natural gas production. And again, same with the oil, shale oil. We had a huge increase in shale gas production, 33% increase from 2017 to 2019. We added 27.5 billion cubic feet a day. Now we hit in 2000, right now we're back at where we were in 2019. And this is the natural decline rate. It's huge. And this is what they forecast our growth is going to be again by the beginning of 2024. It's going to be about 3.6 billion cubic feet a day. That's 3%. So we're not going to have the massive growth. The growth is over in the world. I don't think the world realizes it. The growth is over. And when growth is over, so is GDP, the ability to grow GDP. And that's very bad news for stocks. That's very bad news for bonds. And that's very bad news for real estate values. So in conclusion about the energy, we're going to get to silver now. When global oil production declines, it will negatively impact world GDP. Falling oil supply will result in declining world GDP. And this, I keep showing this chart. We've got world GDP in the blue per capita, the change per year. And then we've got the total world oil consumption per capita change per year. And you could see they trend hand in hand. So this is something the economists tend to ignore at their own peril. And of course, the global coal industry, people think we're going to go to green energy, we're going to go to coal, we're going to ramp up natural gas. Neither of those are going to work because why? I'll just give you the example here of coal. The global coal industry is highly dependent on diesel, mining, and transportation infrastructure. And what are we dealing with now due to the Russian war? There's shortages of diesel. Because it's not the gasoline that's so important for people to go to Starbucks or Walmart or Walt Disney World. It's the trucks, it's the trains, it's the mining equipment, it's the ships, the barges. These are the ones that move all the stuff that we buy. And if there's diesel shortages, that means there's going to be less coal production because it takes a lot of diesel to extract the coal, to truck the coal, ship it by rail or barge or ship. The market totally does not understand this relationship. And lastly, I hear a lot from the tech guys that we're going to have another roaring 20s. All the tech guys, the crypto guys, bless their hearts, are talking about we're going to see another huge tech boom, crypto, NFTs, flying cars, all this new tech stuff. And so we're not going to do it because the only reason why we had the roaring 20s in the 1920s was due to this massive increase in oil production in the United States, because the US was the largest oil producer in the world up into the 40s, producing 70% of all the oil in the world. Not many people realize that. So in 1954, in the 1920s, 154% increased that decade. And that allowed the United States to be the huge global car producer. The rest of the world, if you look at these numbers, was a fraction, 15%, where the US was producing 85%. With all those cars, you need roads, you need highways, you need new restaurants, you need new hotels. All these businesses sprung up due to the oil. So we're not going to have, as I showed you, we're not going to have the oil increase the next decade. It'll be lucky if we get back up to the high and remain there for a year or so and then we start to decline. So there's not going to be any roaring tech 20s. Those days are over for the world. So what is the key investor? And I keep trying to re-educate and silver investors because they have been told over and over that the ETFs are fraudulent. And I'm not saying they're not to some degree, but there's two different markets. There's the silver ETFs, and they cater mostly to the institutions and large investors. Because if you've got $100 billion and you're an institutional investor, you're not going to call up your local dealer and buy $500 million worth of silver eagles. It's going to take you years to get that. There's just not the bullion there. They go into the ETFs. And that's where that's where they will go. And then there's the small and medium investors here. They go in the silver bar and coin. Now, of course, small and medium investors can buy the silver ETFs, and some institutions and large investors will buy some silver bar and coin. But again, institutions control 80% of the market. So when they start moving into silver ETFs in a big way, and they will, that's would be the key driver of price, which will also push up the price of bullion, of course. So we have to understand there's two different markets. And those who say that JP Morgan doesn't have all the silver, if that happens and these large institutions move into the iShares SLV and there isn't the silver there, they have fleets, or they have a room full of lawyers to sue JP Morgan, these huge institutions. But again, JP Morgan warned us in their prospectus that if during the next big demand for silver, they may not be able to get the silver, they would have not said that or changed their prospectus if they could print all the 1,000 ounce silver bars. I believe we're going to see a tightness in the wholesale silver market, and that's going to happen when institutions start moving into these silver ETFs. Now, I want to show you some interesting things happening. There's some big changes happening in the silver ETFs because of the dynamics now since the Russian-Ukraine war. Germany is the powerhouse of Europe. It's really getting hit now. And so on the 25th of March, we saw a 14 million ounce withdrawal just in one day from Deutsche Bank. Deutsche Bank withdrew 14 million. And this is due to, I found out that Deutsche Bank is likely selling silver for margins in other areas because Germany is in serious trouble now. And then on April 22nd, I'm going to show you a chart showing these different days. But we had the last week, we had silver falling, but JP Morgan and ETF securities and even Sprott kept adding silver. But look at Deutsche Bank, almost another 10 million ounces of silver liquidated. And so this continues in Germany. So this is Deutsche Bank. Look at this. Before the pandemic shutdown, Deutsche Bank had a little more than 30 million ounces, went all the way up to 75 million. Look at that, all the way down here. So they liquidated silver due to issues, margins and other aspects in their market, because here we see from Bloomberg, Germany to borrow an extra 40 billion euros to cushion the war blow. I mean, I don't really think the market understands what trouble Europe is as this Russian-Ukraine war continues to escalate. Because if they ban Russian oil and natural gas, the European economy, Germany, is going to go into severe depression. And so this is a very bad situation for Europe. But this is what I wanted to show you. On March 25th, at this high right here, there was 552 million ounces. This is the silver ETF price. That's where it was. It hit almost $24, came down, went back up. On April 20th, the SLV added 2.9 million. Down here, it added 3.5 million. So it's a total of 581 million. Now, as of today, with this big sell-off, they did liquidate about 2 million ounces, but it was interesting to see that JP Morgan continued to add. And it's not JP Morgan, it's large institutions want shares and they move silver allocated into the ETF. So it is interesting to see that the ETFs are still holding very high, even though the silver price and the silver ETF price has been declining. So again, the silver ETFs have been where the major price driver of silver have been in the last 10, 15 years, both for silver and for gold. And I can show you right here. When the ETFs were adding, it wasn't JP Morgan adding the silver. Again, it's institutions moving into silver. It's institutions moving into silver and acquiring shares. And many of them still are holding on to that. So we had higher silver prices because the net silver ETF demand is shown in white and bar and coin is in blue. So when you see a lot of white bars, we had higher prices. When you didn't see any white bars, especially in 13, 14, 15, the prices fell. And then again, we had a huge demand for silver by the ETFs due to the pandemic shutdown. Wait till the future. This is nothing. Wait till the future. And so now we have higher prices again. So the silver price trends higher, mostly from large ETF demand, and declines and then declines and stays flat when ETF demand is weak. And this is the same with gold. It isn't the physical demand that's driving the price. Yes, in the future, physical demand will drive the gold and silver price, but now it will continue to be the institutions because institutions control 80% of the market funds. So here's the gold price and the gold line. And when you the big move up in gold ETF demand, we see the price move up. Then the big decline when there was huge net outflow. Then we had increase here in 2016, and then the big increase in 19 and 20. And then it fell off a little bit in 2021. So we can ignore this information or we can look at it, but this is going to be the place where the fireworks in the silver market are going to occur. So showing you some interesting things taking place in the physical market, this is global official silver coin investment. It's the highest ever, 154 million ounces of silver official coins in 1 year. And that's probably going to be high. It may not be as high because I know the US Mint is having difficulty accessing silver, but this is a very good sign. And where did these official sales come from? Well, we had 37.1 million ounces of silver coins, mostly the Canadian maples from Royal Mint, 32.2 million ounces of mostly silver eagles. Australia had 20 million. The UK investors were moving to in 2021 because it was hard to get silver eagles and maples, and due to the high premiums for silver eagles, they're still like $13, $14. But the Royal Canadian Mint are much lower, but the Britannias several months ago, 3-4 months ago, were very low. They've gone up. So people were moving towards the silver Britannias. And then the harmonics, this is the Austrian mint, and even the South African mint. I mean, 3-4 years ago, they were producing hardly anything. Now they produce 10.3 million ounces of official coins, mostly are the silver Krugerrand. And look at China, 6.9, India, 6.7. So the top 6 official mints produced 83%, of the total, 154 million ounces, and that's Canada, US, Australia, UK, Austria, and South Africa. And I believe these 3 are going to remain strong because more investors are going to choose those over the higher premium Canada and US coins. Now, one thing I differ from most analysts, even though industrial demand is part of the demand, it's a very big part of demand, I think it's going to be less and less of an impact, especially when we start going over the energy cliff. There's not going to be enough silver to do green energy. There's not going to be enough metals or materials to ramp up green, wind, solar, and EVs. Even though there still be more demand, we can see more industrial demand increased. The trend for industrial demand has been lower. Look at the trend of physical silver investment. It's been trending higher. And it actually surpassed last year, as I've shown, last year too, more than industrial demand. When you add, this is physical silver, it should be physical silver and ETF demand. See, physical and ETF investment, this is both of them. So we're seeing now that the investment demand will overtake industrial demand. The key moving forward for the price of silver won't be industrial demand. It's going to be an investment demand, and it's going to be explosive investment demand led by institutional investors. And let me tell you, if you look at these institutional investors' ownership of the ETFs, the typical allocation is like 0.2%. But that's the average, 0.2, not even 1%, it's 0.2% is the institutional allocation. The big banks, the big institutions, it's 0.005%. That's how small it is. So if we just get a double or triple of this kind of investment demand just from the ETFs, we're talking a double tripling of the silver price. So I hope some of this information brought it together. There's a lot of analysts out there talking about the silver short squeeze and the comics and the manipulation. I had to tell you all that. That's all past due now. That's old news. It doesn't matter anymore. It really doesn't matter anymore. What matters is what happens with energy. And now, due to energy becoming scarce in the future, the world is going to transition from building wealth to protect it. You can't protect wealth in stocks, bonds, and real estate. You can only protect it in real assets, especially physical gold and silver. And institutions are going to figure that out here in the future. And that's where we're going to see the big price drive. Well, thank you very much. Have a good day.